Alright, hello guys. This is just a video of how to use the Fibonacci. Fibonacci is one important tool in the market that most traders and mostly beginner traders do neglect. But oftentimes it's a very nice tool that if you want how to use it, you can know how to navigate around the forex market and always come out profitable. So this is going to be a quick one. I don't want to make the video very long. So please, after the video, you can always once you like the video, you can always show appreciation by liking the video and even subscribing to the YouTube channel, so that if I drop any other content like this, you can always have yourself updated on it and get in hand with us. So Fibonacci oftentimes Fibonacci is usually used in a trending market. There are four types of market structures. First, they have the, like you said in our previous video. If you lack insight on that, you can always refer to the previous video. We have four types of market. We have the trending market. We have in the four types of market. First of all, one of them are the same, but then they have different characteristics. So we have trending market, we have ranging market, and then we have a choppy market. So the very first one, that first one can be split into two to have two. Like it can be that one can be split. The trending market can be split into two to have two types of market. So we have an uptrend market and then we have a downtrend market. Then we have a ranging market, the one that's ranging. If you don't understand this, you can go to the previous video. It's there and refer to it. And then we also have what we have a choppy market. The choppy market is the one that you cannot trade, right? This not it's not just an indecision, but there's chaos in the market. That is, the market has no definite direction. And as traders, you cannot trade such a market. You stay away, right? Because you're not gamblers. You're traders. Traders are not gamblers. So you stay away. If not, you'll be gambling. So because the market lacks definite direction. So the ones you trade are the trending and the ranging market. Some trader does not even trade the ranging market, but it's tradable. We can trade the ranging market and then of course the trending market, which is the uptrend and the downtrend market. So but then the Fibonacci is used only for what? Trending market. It's never used for what? Ranging or market. So I will do a quick video on this. I want to do a quick practice to show to practicalize what I've just said. So when the market, well, first of all, use it for a downtrend scenario and then go for an uptrend scenario. So when the market is an uptrend, if the market is in a downtrend, we for example, I'll even use my tool here, right? So this is a downtrend. As you can look at the charts, this is a downtrend, right? You can see the market is making higher highs and what higher lows. You can always identify it by drawing your trend lines. So I hope you know how to apply your trend lines. You draw the lows. Since it's a downtrend, you draw it to connect all the resistance points, right? All the highs, all the swing highs. Once you have done this, you can tell that this is a downtrend market, and each time the market touches the trend line up, it always bounce down back. Okay, it always bounce down, right? It bounce down. So each time you see how you see it touched here, and then it broke lower, and then up to this point, then buyers came in and took it up to the resistance point, and then it went down again down to this point, and then it came back again up to this point, and then back down again to this point. You see, I hope you can see the bubbles I'm using to touch the screen. That's how you can identify the touches, right? Here the same thing, it came down to this point and then to the trend line again and then rejected again back. So the market has been respecting the trend line. So to apply your Fibonacci, you use the Fibonacci to measure the point of retracement, the level of retracement, right? So when you say, for example, let's draw the trend line again. So we connect the trend line, sorry, say we connect the trend line again here, right? So showing that this is a downtrend. Now we know that each time the market touches the trend line, it usually goes down back. Like here, for example, it came here to touch the trend line and then went down. So sellers who came here, who took a sell at this point here after their confirmations and stayed in the market up to this point, has made a lot of profit, right? That's a lot of profit. If you look at the PIP, you find that it's over 300 pips, or if not more. right? In fact, they have made a lot of money from here to there. So, so traders now, what you do using the Fibonacci. Now you use the Fibonacci to measure the point of what the level of retracement, the extent of retracement. Now the market. I hope you know. If you don't understand the word retracement, refer back to my video. I made a video. I made a list of this what's it called? These terminologies, right? If you see your impulsive move, you see your retracement, you see your trend lines. I support and resistance. I made that video, and if you go through the video, you understand. You pretty much understand what I'm saying. So when I say retracement, as the market got to this point, to this resistance, and then went down all the way to this point here. Hope you can see the bubble. It was at this point here, hmm, and then went down all the way to this point here, right? As it went, since you are in downtrend, the market shouldn't go up now, but not so, because according to the law of price action, market does not just go down wholly, right? It usually goes down. If it's in a downtrend, it goes down about 100%, for example, and then it makes its retracement to about highest. So you can make the retracement to about 30, 20%, 50%, 80% retracement. That is the point where the market goes up a little before continuing down, right? That's what they call retracement. So the market fell from this resistance point down to this point here, right, and then began to move up again to test the trend line. So at this point, as you saw the confirmation that market is beginning to retrace, how you know that is that you begin to first of all see a dodgy, some of these candlesticks that is saying, that is communicating that the market is about to turn. Well, they hope you get that when the market is about to turn, those confirmations, when like here you can see, I can even spot that the dodgy here. So as a seller, once you come here and see that there's a dodgy coming up here, you can stay away. And then you now see bullish candlestick formation. What you should be entering your head that the market is about to retrace. At that point, you stay away. But what you do is that you draw your Fibonacci to note where the points where the market is going to retrace up to before continuing downward, right? So the market came from here and then gave you profits from this point down to this point, and then you are here. You now saw that the market is not willing to go down any further because of its retracement. That point, you begin to draw your retracement. You begin to draw your Fibonacci. So Fibonacci is drawn from, since it's in a downtrend, it's going to be from that point where the previous high, right? You draw it from the previous high to the recent low. So this is the previous high where the market, this was the previous swing high. So now you draw it from here down to the point where it stopped, where you started seeing that reversal signal. So I will do it here, but I will practicalize it now. So I'll go to I think this is my MT5. You go to your two bars. Now you click on the Fibonacci retracement tool. You click on it. That's it. So you come down to this point. You draw it from this point, from the swing high, right? You draw it from the swing high and then down to the swing low. So this was the highest low here before it started retracing. So you can see that it was at this point the market started retracing. That is when it started going upward, even though it was a downtrend market. So now you wait for it. Then where you see, now you always take your entry at the final point where the market got to now before rejecting. You can know that point by, you hope you understand your candlestick pattern. Now at this point, this is the point where the market got to, and then you can see some signals, this thing that looks like dodgy at this point. So the market got stopped or stopped its retracement at what, at 38.2%. So at 8.2%, the market stopped its retracement, and then she gave you some signal that is about to turn again down to the back down, right? So at the 38.2%, the market said what? It gave you the first signal. The first candles, the two candlesticks there looks like what, a dodgy. Then the second one, you might not enter that two candlestick there, you can see, but the second one, the second one there, hope you can see very clearly. So this is the two candlestick. The market retraced up to this level, and then at 38.2, it stopped. It didn't go any further. It didn't test up to 50% here or 61.8%. Instead, it stopped at what, 38. It tested 38.2%, and then started what, going down. So you enter as long as you as soon as you spotted these two candlesticks first, because it shows you indecision. Nothing much is happening, and you can see how the first candlestick tells you that buyers are not strong again in the market. The second one tells you that sellers are beginning to enter. The third candlestick tells you that you can see that the third candlestick, the body of the third candlestick is bigger than the first two you can see here, telling that they showing you the presence of what the sellers in the market. That sellers are beginning to enter back again to push the market lower. So at this point where you see this 38, the market tested 38.2 twice, and the third one below 38.2 is a good signal. Is a really good confirmation for it to start what to enter, to trigger your what your entry, your selling entry. So that at that point you trigger your sell. You can now put your sell order, and then of course begin to drive, and then wait for the next, and wait patiently. Of course you can go and look for a area of interest where you can take your profit, right? So you can see that the market, from after it tested 38.2% of the Fibonacci levels, it fell all the way to this level here. You see that? All the way to this my this zone here. You see my other block I have put here. The market got to that point before doing another retracement, before it started retracing again to test the trend line. So you see how we can practically look at the Fibonacci tool, and of just know what you're to do, the order you're to do in the market, to take in the market, right? So that's what it helps you to guide. It guides you to take decisions in the market, right? You have a mental framework of what the market is about to do, and of course you enter the right time, and of course pull out the profit of the market. So this is a very short video, so you can go through the video and make sure you grab all the informations that I've communicated here. So please do well to share the video, and of course like and comment. Okay, I will be releasing the next video, and if you have any area you want me to touch in the video, maybe now subsequent and this in touchings on the forex market, you can always drop a comment for me. I want to do it personally. Okay, I want to do the video and drop it, right, for your educational purpose. So stay cool. Jesus loves you.